In the last video, we saw how foreign exchange pairs trade and how they trade with a bid and an ask spread. But now let's go and look at some actual trading examples. Now let's look at trading sizes first. In foreign exchange, trading is done in standard lots, which is equivalent to 100,000 nominal, a mini lot, which is 10,000 nominal, and a micro lot, which is 1,000 nominal. Now, what does this mean? For example, if we look at Euro US dollar, let's say it's quoted at 136.76 to 136.78. That's the bid and ask. Then going long of one standard lot means buying 100,000 euros and selling short 136,780 US dollars. That's simple enough. Conversely, if you were going short of one mini lot, it would mean selling 10,000 euros and going long of $13,676. If we're looking at the US dollar Japanese yen, and the quote was 77.16 to 77.18, then going long one micro lot would mean buying $1,000 and selling short 77,180 yen. So I hope that makes sense. Now let's look at a typical trade. Let's make it a winner. Okay, in this case we're looking at sterling US dollar, and it's being quoted at 154.77 to 154.80. Because we think the pound is going to go up and is going to gain against the dollar, we buy one lot at 154.80, which is the ask or the offer side of the market. That means we are buying 100,000 pounds, and it's costing us 154,800 US dollars. But with 100-to-1 leverage, we only need to have $1,548 in the account as initial margin, assuming we don't have any other positions, of course. Okay, so we're long of one lot at 154.80, and now the price goes up to 155.40, 155.43. We want to take our profit because we have a profit of 60 pips. So we hit the bid at 155.40 and we sell one lot. That means we sell 100,000 pounds and receive 155,400 US dollars, thus making a profit of $600. The profit in pips, as I said, was 60. So in monetary terms, it's $600. Therefore, 1 pip equals $10 per lot. Let's look at another trade, a loser this time. In this example, we're looking at US dollar Canada. It's quoted at 103.36 to 103.40. We think the US dollar is going to gain against the Canadian dollar, so we buy one lot at 103.40 on the ask side of the market. So we are buying 100,000 US dollars and it's costing us 103,400 Canadian dollars. With 200-to-1 leverage, again, I'm using 200-to-1 here as leverage just to make the math a little bit simpler. But with 200-to-1 leverage, our initial margin is 103,400 divided by 200, which is 517 Canadian dollars or 500 US dollars. Now this time the price has gone against us. It's gone down to 103.20 to 103.24. We decide that it's gone down enough and we don't want to take any more loss, so we sell one lot at 103.20. i.e. we sell 100,000 US dollars and receive 103,200 Canadian for a loss of 200 Canadian dollars. Now take note, we have lost 20 pips, that is the difference between 103.40, which is what we were long at, and 103.20, where we sold. And in this case, 1 pip is 10 Canadian dollars, and that translates to 9.69 US dollars. And it's not 10 US dollars like it was in the previous example. This is important from a risk management point of view. The value of a pip differs depending on which currency pair you're trading. This is very important. To fully illustrate this point, here is a table of pip values. As you can see, different currency pairs carry different pip values. And this is determined, of course, by the current market price. So this table you will see will need to be updated on a regular basis with the current prices in those 6 major currencies. And this will calculate the pip values on the right-hand side, which is all the cross currencies related to these 6 majors. Now, as I said, it's important to be able to calculate these pip values for risk management purposes. And the best way to describe this and explain it is this. Let's assume you have an account of 4,000 US dollars and you are going to take a trade, and the maximum risk you want to allocate to this trade is 5%. That would be 200 US dollars. Now you've calculated that your stop loss is going to be 50 pips below your entry. Now how you've arrived at this is irrelevant for the purpose of this discussion. We will look at stop placement in later presentations. But for the sake of this example, let's just assume that you've made that decision. Your stop loss is going to be 50 pips below your entry. Now what does that mean? That means that because you're only willing to lose $200, your maximum loss per pip has to be $200 divided by 50, i.e. $4 per pip. Now let's say you were actually going long of euro sterling, for example. Euro sterling, as you can see here, at the current market prices, would carry a pip value of 15.51 US dollars. So your maximum position size, given that you're only allowed to lose $4 per pip, will be $4 divided by 15.51 or 0.26 lots. 0.26 lots is 2.6 mini lots, but of course you can't buy in decimals, so you wouldn't be able to buy 2.6 mini lots. You would have to buy either 2 or 3, and that would throw your entire risk management out of whack. So that's where trading micro lots becomes useful. So 0.26 lots becomes 26 microlots. This is the foundation of risk management. It helps you decide how big your position can be depending on the maximum loss that you're willing to take. And depending on which currency you're trading, in many cases the pip values will be different, and therefore your trading size will be different. I hope that makes it clear. The next thing we need to look at is margin. Now let's assume you have an account balance of $1,000, and let's assume you're going long of one lot in US dollar Swiss franc at 200 to 1 leverage. The margin requirement therefore is $500. I think we should all be okay with that by now. Now, if the market is going down and you're losing, say, $600, then the equity in your account, which is equal to the balance minus the unrealized loss, is $1,000 minus 600, which is, in this case, $400. Remember, that is the equity in your account. So the margin cover, or otherwise known as margin level, which is the ratio equity divided by margin, would be equal to 400 divided by 500, or 0.8, or 80%.
Now, why is this relevant? Well, with most brokers,
when margin level becomes equal or less than 10%, which means that your equity is 10% of 500 in this case, i.e. $50, then you're automatically closed out to prevent losing everything. But this is not guaranteed. You will see in the last video of our Trading Basics series that indeed it is possible to lose more than you have in your account. And this can happen in really fast markets or over weekends, but we will go into that into more detail. So once again, thanks very much for watching, and we look forward to seeing you in the 5th video in the Trading Basics series, Mechanics of Trading. Thank you and goodbye.